Do you realize yourself at this point how much of an impact you've had on the entire industry, both from the professional to the retail?
I do actually, because actually there are now been 5 Market Wizard interview books. And I found some of the best traders I've ever interviewed were in that book. Maybe the single best trader I ever interviewed was in that book. One trader turned literally 5,000 into, well, 50 million when I spoke to him, but in the subsequent years, I updated the book, he turned it into 250. What makes you successful where so many other people aren't? And the answers to that are price reflects everything that happens in the market. There's a reason to believe that the price and patterns in price could be meaningful. But the key is lots of traders I've interviewed were pure fundamental analysts and did extremely well. For some people, that's the way to go. But for me, what I discovered was
a quote that I believe you've said, but also has been reflected from one of your interviewees or one of the traders that you knew personally, was knowing where to get out before knowing where your profit is, or before getting in. Why is that so important?
Yeah, so that's out of all the books I've written, all the advice I can give people, if somebody said, Jack, you got to give advice to trading, but there's only one catch here. You could only use 10 words. And I know what the 10 words would be, and it's
#1 podcast in the trading space, the fastest growing, and that's thanks to every single one of you. Hey guys, before we get into this incredible episode of Words of Rizdom, I want to let you know how you can get a free trading plan. Very simple. Go in the link below. You're going to see 2 links. One for Telegram. There you'll get free mindset hacks, a free technical course, free updates and polls on the podcast. And then the other link is our new email newsletter. Click that link, sign up. You'll get a free trading plan PDF sent directly to you and get incredible value all week long. Let's get into this episode. Welcome everyone back to the Words of Rizdom podcast, the #1 podcast in the trading space. Thanks to all of you and our incredible guests, talking of which we have an absolutely incredible guest with us today. I'm a bit nervous, and I don't get nervous. It's been a very long time, and you'll all understand why. This guest is renowned and famous across our industry. I've heard about his work so many times in the podcast from other guests, as well as when I was learning in my trading journey too. His first book was A Complete Guide to Futures Trading. And then, of course, the infamous Market Wizard series. And I'm so happy to announce that we have with us today, Jack Schwager. Thank you for being here, Jack.
Thank you, Riz. Glad to be here.
We're in sunny Florida, right?
Sort of a 4-day straight rain, yeah.
Well, Jack, I'm sure many people know your journey, but just to start off the podcast, just in case anyone doesn't, could we just get a little brief introduction to sort of your journey and your career and sort of how you got to where you are today?
Sure. I basically fell into trading. Unlike a lot of the people I interview who had an early passion for trading, which is actually one of the tells for great traders. A lot of them tend to begin early. That was not my case, and also I'm not a great trader, so that makes sense. But in my case, I didn't have any plans other than to do something analytical. I came out of graduate school for an economics degree, was looking for a job, and I thought I'd get a job immediately. I came out of an Ivy League school. I thought, I'd have a job the first day I looked. I went to employment agencies, went through that routine. After a couple of weeks, I was getting a little discouraged, but I went to the Times, I put an ad in the Times. And I don't know if they still have it, but those days you could do, looking for a job type of ad. And I just did a cheap, like $15 ad, 2 lines, basically saying MA Economics, Brown, minor math, and looking for some analytical job. Maybe that was it. And I got 15 calls. I won't go into all the ones that 14 of them were complete garbage. With like sales type of positions. They try to get you pyramid schemes, that type of thing. One was a legitimate call. And I went for the interview, and that was for a commodity analyst job. And I didn't know anything about commodities. And back, even today, I don't, there are some futures courses, but back then, futures were not anywhere. It had nothing to do with academia. Even markets had very little to do with academia. So I knew nothing. And I remember in the interview, I was asked, what do you know about, commodities? And I said, well, not much. And the answer I gave was so stupid, I still remember it to this day. I said something like gold, and it's embarrassing how naive I was. But the director of research who was interviewing me was writing a column for it was from Barron's, and he was doing a weekly column, and he narrowed down the list. For some reason, I did something right in the interview, but he narrowed it down to 4 people, and he had each of us write an article on some market, which he then used as base research for his column. So I got assigned copper, and I then I lived in Brooklyn, New York, and there's this huge library called Grand Army Plaza. I literally spent a week in that library, just reading everything I could on copper, from some articles I could find, yearbooks, weekly magazine. There was a metals bulletin from McGraw-Hill. There was a daily metal. And I tried to become an expert in copper in 1 week. And I wrote the article, and it was later told that he had passed around the articles to people at the office, and everybody said, pick this guy. So actually the article I wrote got me the job, and that was a position as just a research analyst. And that's how I got involved in the business. I really had no intention into going into markets. It was just by writing it by happenstance.
It's incredible. So even then, your writing skills were...
It was my writing skills that got me into this whole business.
Was your writing skills something that you developed over time, or was it something you kind of had a natural ability for?
I discovered it. I really didn't know. I mean, there were instances like I remember in college, I took, let's say, history. It happened a couple of times. It was a history course, and with some paper we had to write. And I happened to miss the day of class, but the following day I was told by my classmates that the professor picked out my paper for its writing, for its good, as an example of a good written piece, and read it, So anyway, so there were instances, but I didn't really know. I just kind of discovered it.
Wow. And as a research analyst, what goes into that role? What is it that you have to do?
Yeah, that was one of the neat things, is there was no definition to what you should do. I was assigned 4 markets at the time: sugar, cotton, cattle, and hogs. I think were the first 4, and just have to sort of start doing research. And I did start doing basic economic research and things, and somehow I wasn't. I should mention right here that in those early years, I not only knew nothing of technical analysis, but I was completely disdainful of it, because you come from an academic background, charts and all this stuff. You kind of tend to automatically come in. Well, at least I came in, but I think it's normal. You come in biased against that type of thing. You think more in economic term, economic fundamentals and so forth. Of course, I changed my mind over the years, but initially I didn't. So I was just doing that type of research and writing weekly articles on each of those markets. There was in those days, the brokerage firms the futures departments they would put out their own weekly publication on the markets, and that was my job.
And in terms of research, the majority of the audience have been trading probably within the last decade. A lot of different markets, of course, but in terms of research, their ability to research or understanding when they visualize it, and the same with me, would have been that, go on Google, go look at articles, but it was a different time.
Yeah.
So what did your level of research
no Google, we had no computers. we had no screens, back, I started in the early 70s.
Yeah.
So, you had and this will be completely alien to most of your audience. But we had those were the days you had these huge boards in the front of the room that would click as the prices changed.
Wow.
And you would look at the board. And again, I wasn't into technical analysis, but there were no charts. There was a weekly chart service that I discovered, eventually, but there was you didn't have any screens, you didn't have you didn't have a computer, so forget anything else that comes with it.
Yeah.
Right?
So what was your process of research?
So, it depends on the market, but essentially let's take a market like hogs, right? So there's all sort of USDA statistics that come out, and how many hogs are born and what the relationship, when they intend to come to market, and what you had historical prices given the amount of hogs that were around and things of that nature. And then you have imports, exports, which weren't a major factor then. But you have anything that affects supply demand, and you would then do like stuff like regression analysis to sort of correlate the supply, the supply to the amount, to the price, and also taking into account things like a steadily rising demand, maybe due to population, anything that would affect the fundamental supply demand. So that was the type of analysis I was doing. So you'd basically get a general idea of, well, this market should be, hogs should be around 55 to 60 cents a pound or whatever. And if they're trading at 50, then you have a bullish bias. It was that type of analysis.
Okay, and then you would be providing that to firms?
Yeah, and I'd be writing that up in the weekly letter.
Mm-hmm. And then based on sort of the next step from there, the traders or firms would be looking at and observing that information and then maybe comparing it to what they're thinking or seeing, or their biases as well?
When you say the traders, you mean...
So based off your research,
yeah,
the next step would be that I imagine a firm would then take that on.
Oh, no, they would just distribute. These were mailed out to clients.
Okay.
So it wasn't, and the brokers would get them too, but they were mailed out to clients, yeah.
Okay, yeah. I understand. And then in terms of the complete guide to futures, as you said to me beforehand, a lot of people don't know that was your first book.
Right.
Where did the inspiration for writing a book come from in the first place?
So sounds conceited when I say this, but I didn't think there was a good book on futures market analysis. And at this point, I'd been in the business for about, 12 years, I think it was. And I decided, well, and this was no intention of sending a lot of copies or anything like selling a lot of copies or becoming a big name author, anything. That was not my mind. I just wanted to write the best textbook on analysis of futures markets. That was my goal. I didn't think there was a really good one out there, and I wanted to write it. So I took a sabbatical. I spent a year. This again is before computer. Well, computers, the PC was there in its infancy, but I wasn't yet using it. And it wasn't. You didn't have. It was just the beginning days of PCs. So it was done by hand, So even like stuff like if I was doing regression analysis and stuff of that nature, I would actually doing by hand calculator. Wow. Not by Excel spreadsheets. The graphs I had to hand do, and the publisher would eventually make them look better.
Yeah.
But everything was done by hand, and it was like a nearly 800-page book, and mostly my own analysis and development. I used for the regression. It ended up being that I was going to write one chapter on regression. It ended up being a whole section, like 6 chapters, because I realized, hey, I couldn't talk about regression until I explained basic statistics, and then I couldn't stop at simple regression. I had to go to multiple regression. Then I had to go to, on and on. So it ended up being a whole section. And I knew when I did it that would decrease sales of the book. I kind of, not semi-facetiously, but not totally, believed that the sales of a book are inversely correlated to the number of formulas. So it was against my interest. But again, I wasn't trying to do it. I was just trying to write a text reference. And so that was the inspiration, and that was the book. And that actually was a catalyst, interestingly, for Market Wizards. If I hadn't done that book, there probably would never have been a Market Wizards.
That's usually how it goes. That's usually how it goes. And you took action in the first place. You take great risk as well, putting things out there, and then it leads to something. As long as you keep taking that action, to something amazing like this. And before we start going into more depth of Market Wizards and the whole series and the impact, that's what I want to talk about first, is the impact. Do you realize yourself at this point how much of an impact you've had on the entire industry, both from the professional to the retail?
Let's take a break for a minute there, guys, because I want to tell you about the best prop firm in the entire industry, Alpha Capital. Let's keep it nice and simple. You want to get paid out, You want to have institutional experience behind the firm. You want to have their own broker so that you can trade on the best platform that all traders love to use. And on top of which, they have their own technology as well, so you know they're here for the long term. Alpha Capital has no commissions as well as part of their trading conditions, which is absolutely incredible. And not only that, they're London's finest. Now, if you want to join them, 20% off using the code RIZ, and the link is in the description below. Now let's get back to the episode.
I do actually, because actually there have now been 5 Market Wizard interview books, the first 2 were done 89, 92, but once I got to the later ones, I was then hitting people that had actually gotten into the business because they read the original Market Wizards, and it became very common, particularly in the later books, that everybody I interviewed had already read, read one or more of my earlier books. But the fact that it influenced a lot of people I interviewed to actually get into the business, and that came up a number of times. So I did realize that there was that impact, and I do get the communication with people, that change their life and that type of thing.
How does that make you feel?
It's good, I try to be realistic about it. I'm lucky I only get the good side. I don't get people saying, I read your book and I lost a fortune, I just really, the communication I get is always the positive side. But I know that I'm getting a biased sampling. But it is good. It is a good feeling to know that at least for many people, I've changed their lives in a very positive way. And so I've had an impact, and it's been a positive impact. So that's always good.
Definitely. And a massively positive impact, I would say, as well. Because as you said, even with myself, I've heard not only just from my own journey, but also from so many people that I've interviewed, how much Market Wizards helped them. And it's always been like a reference point. And if anything, it's almost like a go-to book. Like whenever someone starts trading, when the usual question is there any books or resources? Market Wizards is normally right up there in the top of the list.
And I know there's a number of hedge fund managers that kind of have anybody to hire read the books, So I've been told that.
Before the book actually went out, did you have a feeling you were onto something?
No, I didn't. I always try to do something that I feel is as good as I can get it. If I'm going to do something, I want it to be as good as I can make it. So I felt it was good, but I didn't know it was going to have that type of that impact and grow. I did have the goal of it being that, because I do remember when I wrote the original Market Wizards, there was a book which many of your listeners may be familiar with called Reminiscences of a Stock Operator, which was written back in the 1920s. About the protagonist is Jesse Livermore. Some people, back in my day, some people thought that the author was a pseudonym for Livermore, but it wasn't. He was a journalist and he wrote books, and he wrote a couple of books on markets, and this was one of them. But he did such a good job of capturing the mind of a trader and everything that the book continued to kind of be relevant years later. I read it 65 years after its publication, or about that much, and I was like amazed that, this is written by a guy from the days of bucket shops and stuff like that, and the stuff is still, it really rings true. So I did have, not that I was writing a similar book, but I did have the idea that I wanted to, when I was doing these interviews, I wanted to have a goal that what I captured is something that would still be relevant 65 years from now, that type of thing. I wasn't thinking of, I wasn't interested in, hey, what's the market going to do for the next year or two or whatever. I was interested in what are the truths about markets and trading that were true 100 years ago that will be true 100 years from now. So I did have that goal. So the fact that it seems the book now, I don't know, is it 35 years or so?
Yeah.
Whatever it is. Now I think it's going this long, it might well end up being the same type of thing. So I didn't expect it, but in my mind it was a goal.
It's so interesting what you said there in terms of you're trying to create something that has that lasting impact. So what was it that you focused on then in terms of your questioning? to last that long, to stand the test of time?
The questions I'm always trying to dig at is, what makes you successful where so many other people aren't? What is it, that explains that? And the answers to that are things that have long-term truth, which stay true even though markets change. Market change tremendously, but yet a lot of the same principles stay true. And my explanation for that is simply that what doesn't change is human nature. We may go from open outcry pits to electronic trading. We may go from no computers to supercomputers. We may go from quants being like a tiny fraction of traders to having now multiple firms with hundreds of quants working for them. So the markets change tremendously, yet some of the basic aspects of what it takes to be successful do not change at all.
It's interesting you mentioned that part in terms of the emotions, because as we continue year on year, we're starting to see a lot more capability when it comes to algorithms and AI. Do you feel like that is something that could shift that perspective or not?
Well, it's been around. We've had this quantification of trading for quite a while now, and it definitely changes things for sure, but it doesn't change it to the point where the individual trader can no longer find a successful route. So I was surprised when I did the most recent book, Unknown Market Wizards. I was kind of not expecting to find and as the name suggests, I should explain, what I decided to do there was to really go just after solo traders, people nobody knows, and just find, but who've been very successful. So I was getting people who had very good long-term track records, but just traded on their own. Nobody knew them or anything like that. And I wasn't expecting to get super track records. I just expecting to get people who did a lot better than the market and stuff. And I found some of the best traders I've ever interviewed were in that book.
Wow. Maybe
the single best trader I ever interviewed was in that book. And that was surprising to me because I said, with all this quantification and all these hedge funds, you would think that now the single guy can't get spectacular results, but no, it still happens. And I think when the results are such that you could say, well, somebody's lucky, yeah, but not lucky for 18 years. And, to give some examples, one of the traders, I should preface saying, what they tend to do is also take profits out and reinvest that and not letting their account compound, otherwise it would be impossible. But like one of the traders, a couple of traders had several 100% average annual return over 12, 15, 18 years, right? And those type of results are just completely astounding. Now, yeah, they didn't compound it, but still they're making those results. That's incredible. One trader turned 5,000 into, 50 million when I spoke to him, but in the subsequent years, and when I updated the book a year ago, he turned it into 250. So just totally astounding. That doesn't happen by luck.
What was your process of finding those traders? Because as you said, they're unknown.
Yeah, so several ways. One, the trader I just mentioned, the one who turned the 5,000 and ultimately to $250 million, I get an email, and this trader says, and at the time, you're not going to believe my story, but I started a $5,000 account and I turned it into 50 million. And I wrote, at that time, I wasn't intending to do another. I just didn't have a plan to do another book. And I wrote him back. I said, well, that's pretty amazing. I said, I'm not planning to do another book, but I'll keep your email on file. And if I do a plan to it and you can prove it, I think that's a great story. So about a year later, I decided to do another book. And I got in touch with him, and he sent me all his monthly statements, from 2005 or 2004, forget when, something back in the mid 2000s, all the way up, 20 years worth almost. Not quite, but close to 20.
Yeah.
And I mean, the numbers were real, right? So that's how I didn't find him; he found me.
Yeah.
And that becomes by becoming recognized on a broader scale in the industry. Sort of, I get to have an advantage that people could find me like that, right?
Yeah.
Some traders I just knew. I knew. The one person who really wasn't completely unknown because he had a big Twitter following was Peter Brandt.
Yeah.
And Peter's a friend, and I know him and all that. And I always thought to myself, and he was kind of a catalyst for doing the book, actually. I always thought he has so much wisdom about the markets. And I always thought, well, I gotta interview. And Peter's my age, so he's, getting on in years, right? And I wanted to make sure I capture what he had to say for posterity, while I could. So, but Peter is still a solo trader, doesn't manage other people's money, is not known within the broader industry, or it wasn't certainly, I think, before the book, but he had a large Twitter following, so he was known through that. Anyway, so that's an example of somebody I knew. And then I was involved with a firm, Fund Seeder, a startup, which is at a trading platform for analytical, let me back that up. Had a trading platform that provided analytics for traders, all sorts of charts and analytics on their trading. It was free. The idea was that was a way to find these unknown traders. And then there was another arm of another company, Fund Seeder Investments, that would then use that data to find traders to put together in product. And so through that, some of the traders came through that. And then I did a tweet, some tweets of my own saying, hey, I'm looking to do another book. If you are, or somebody who's truly an exceptional trader, long track record, is superb, return to risk, let me know. And I got a number of suggestions that way. So between those avenues, I had a book's worth of people.
And how did that compare to your first book? I know that personal connections
helped you.
The first book, of
course, we have no internet and we have nothing, right? So the first book, I knew some of the traders. The job we talked about earlier, that I landed that technical analyst job. Well, the person vacating that job was Michael Marcus, who ended up being, now he was leaving to, in quotes, become a trader. And so he was cleaning out his desk the day I came in from my first day of work. And we talked a little bit. He was still in New York for a few years, and we used to get together for lunch and stuff like that. So I knew him on a personal basis. And Michael went on to Commodities Corp, where he famously turned, well, maybe famously through my book, turned a $30,000 account into $80 million. But Michael then, he hired Bruce Governor. And so for Michael, I knew Bruce. And I think a couple of other traders, and from some of the traders, I got other traders. And so that's how I got, and then some of the traders I might have, were known at a more widely. Something like Jim Rogers, who was originally George Soros' partner and was, he kind of retired from that, was just managing his own money. And was teaching a course in Columbia because he wanted to teach it. And sort of I sent them my book, The Complete Guide to the Futures Markets, and say, hey, look, I'm not a journalist. I wanted to do a serious book on trade. And said, got him to. So that's how I got the people in the first book.
Do you feel, as you just mentioned there, I think that's quite interesting, is that people may have been a bit more open to your interview versus, as you say, like a journalist or something like that, because maybe there wasn't a particular angle that was going with it. It was more so, as you were saying, the value that could be given back to the wider community.
Right. I mean, yeah. So I tried to convey that I'm not trying to do any gotcha. I'm really just trying to get to the essence of trading and markets and what wisdom you might have to share. And I did something else, which I've continued to do for every book, which was to say to everybody, look, I'll send you a copy of the final draft, and you can review it if there's anything wrong, and if there's something you disagree with or whatever, we can, if it's wrong, we can change it. If we disagree, we will find a common agreement on how to handle that that section or text or whatever. It came up very rarely. And so that assurance that I would let them see the final draft, that wouldn't just go out, that I think was helpful in getting the interview, but also helpful in getting them to be open, because everybody otherwise would be sort of second guessing themselves about what they're going to say if it's going to appear in print.
Yeah, in case they couldn't control or have any sort of thoughts on
what
was going out.
So that was I think that helped. That was helpful in getting people, and more importantly, maybe in getting them to be more open in the interviews.
Definitely. One thing you mentioned very early on there, which I found very interesting, was that at one point you didn't believe in technical analysis at all.
Right.
What changed? Like, what was it that changed for
So
you?
what changed it was a couple of things, and they were kind of related, and it was very pivotal for myself. I was a researcher. After a couple of years in the business, I got a job. I switched from being just an analyst to getting a job as the actual research director. Also, writing helped in that. There was a magazine at the time, it was called Commodities. It eventually ended up being Futures, then eventually changed again, the name. But back then it was called Commodities. And I became a contributing editor to that. So that helped me get a job as a director of futures research. And one of my analysts was a technical analyst called Steve Kronowitz, who became a very close friend. Steve and I shared an office, and I noticed something. I had a bunch of fundamental analysts reporting to me, and I had Steve as the only technical analyst. And of all the analysts, he was the only one who was more right than wrong, right? So I had to be open to it. I said, so Steve, tell me what you're doing, and why and what. So from him, first of all, I learned technical analysis, and I understood, got an appreciation of why it could work, which is simply that it's not mumbo jumbo, it's not black magic, it's the price reflects everything that happens in the market. So there's a reason to believe that the price and patterns in price could be meaningful. So that's one element of it, and I sort of started experimenting with that. But the key is, and this is really critical, and I do not mean here to demean fundamental analysis, because lots of traders I've interviewed were pure fundamental analysts and did extremely well with it. So for some people, that's the way to go. But for me, what I discovered was that besides it not being that effective, what I discovered was that it worked in contradiction almost to risk management. And one of the most important things I learned, maybe the most important thing I ever learned in my journey in interviewing traders and trading, was that it's really risk management first and foremost. You may think it's boring, you may not think it's what you're interested in, but it's the most important element. If you don't have that, you don't have anything. And what I discovered was that fundamental analysis is in many ways very difficult to make compatible with risk management. So say I think, hey, the wheat market is undervalued here. It's $5, a bushel, and I think it should be $6. Well, it goes down to $4.50, and fundamentals have not changed. What should I be doing? I should be buying more. So it's this ironic element that the more things go against you, if the fundamentals don't change, the more it would have you, adding to the position. I mean, it could be a stock as well, right? You like a stock at 50, you think it's going to 100. Well, if it goes down to 40 and nothing has really changed, you should buy more, right? And of course, that's exactly the opposite thing you should be doing from a risk management standpoint. You should be getting out or at least reducing your position if things are going against you. So, and I discovered was that it was really critical to be able to control your risk. And with technical analysis, almost by definition, if the market goes against you, then your analysis is wrong. And it works, by the way, regardless of whether you're a trend follower or a contrarian. Because let's say if you're a trend follower, it's obvious. The market breaks out. I think it's going higher. But if it comes back into the range, then something's wrong. The breakout, my assumption this was a real breakout is wrong. I'm out. Okay, so it's very easy to make the risk to pick a stop that's consistent with your analysis. Same thing if you're you're contrarian and you say, okay, this market is coming into a range where there's lots of resistance, it's oversold, it's overbought. I'm going to go short here, but it shouldn't go to new highs or something like that, or it shouldn't go X points beyond the old high. So again, you have a natural point where it shouldn't go, and if it goes there. So technical analysis is really beautifully compatible with risk management. So for me, ultimately, that became the transition where I went from being 100% fundamentals to being 100% technical. So again, and I think that may apply for a lot of people because of this risk management element. But again, there are lots of people who are pure fundamental analysts and make it work well.
It's one key theme that I noticed from the Market Wizard series is, of course, that everyone had a different style of trading, and yet they still made it work. But as you mentioned, risk management seemed to be the key theme that they would always mention in terms of what would be their advice, what would be normally their one thing. It was either risk management or a lot of the time to trade with the trend. Is that something that you noticed as well? Yeah,
well, risk management is, you talk about common denominators, it's not 100% common denominator, but pretty darn close. In fact, when there was an exception, it was so glaring that it was obvious. And I can only think of, I can think of a couple of exceptions. I can think of two right off the top, but that's out of 5 books of interviews. And for almost everybody else, risk management was always really important.
I remember one particular trader, and they had mentioned in terms of, I remember actually in the interview, they only gave you a lot amount of time. I believe it was an hour or 2 maybe max. And you'd even written in the book, like you were thinking about how you might get there and it'd be more comfortable and get more time, and you couldn't do it. So what did you do in that scenario?
So that happened several times. Several times, yeah. I mean, Richard Dennis was like that. I mean, Richard Dennis gave me an hour twice. Ray Dalio, same thing. He gave me an hour twice. Wow. So there were a couple of people that were, the worst one of all was Tom Baldwin. And Tom Baldwin, at the time, he was a pit trader in the bonds, and he traded enormous size, really enormous size. He was one of the biggest traders in the pit, just for his own account. Wow. I mean, he's trading the size of Morgan Stanley and Solomon Brothers, whatever, just for his own account. And interestingly enough, he was like, I forget what his job was. Originally, he was like working in a supermarket or something like that. So It was a really good story. So I had to get Tom, and I got Tom because there was another trader I interviewed who's was a friend, and he sort of convinced Tom to do it. And Tom didn't want to do it. So I interviewed him, and unfortunately, to make things even worse, it was St. Patrick's Day in Chicago. When they're in the river's green, everybody's going out to the bars. And, the interview set up obviously after market hours because he's a pit trader, right? So he comes back to the office and he's there and he's clear he's not going to have a lot of time. And people are coming in, hey, Tom, you got to meet us at the, yeah, I'll be there. So I knew this was like, I said, I felt like I was a photographer who was trying to get a picture of a rare bird that was about to fly away at an instant, And I knew I just had that, before he could finish answering a question, I had to have another one. I couldn't and there was, after about 35, 40 minutes, there was one point where there was like maybe a 3-second, pause between his finished answer before I get he's gone, So that was like the toughest situation I had. But somehow I got enough to make a decent interview out of it.
Incredible.
But it would have to be very intense.
Yeah.
To for that period.
Did you find that? Did you find that it was each interview kind of was a bit unique, due to, of course, different personalities, different things that impacted the interview, whether it be time or anything else? Did you find that each one you had to use a different type of either questioning or angle?
There, not so much that as one of my things that I do and I think you do the same thing, is, in fact, you are doing the same thing, is to have a conversation, not to go in sort of a prepared, list of questions, and then go to the next question regardless of what the answer is, because the answers often lead into more interesting tangent. Sort of like you picked up on my comment about my not being a technical analysis, sort of used that as one of your questions later on. So I try to do the same thing. So that I do really just universally. But different people, there may be differences, and it has to do with the length of also the interviews. I have interviews where I know there's more stuff, but I just have to keep on as long as I don't get thrown out, just to keep the interview going. And as I mentioned to you before we started this official interview here, that one trader where first couple of hours I got nothing, and it ended up being my favorite chapter in New Market Wizard. So that has to be adjusted to the person. In some cases, it becomes almost impossible. So So there's a trader, Gary Bielfeld. This is kind of interesting. Remember, I told you I was a research director and a research analyst, and so in those days, you got the wires that come across. You have to do daily comments at the end of the day that would be broadcast to the brokers and all through different offices, and what went on in the markets, and sometimes write a summary too. So you'd look at the wires, and I'd see, let's say the bond market. It says, okay, you see this BLH kind of being mentioned as a big trader in the bonds, along with names like Solomon Morgan and so forth. And I kind of asked, who the hell's BLH? I find out BLH is one guy in Peoria. And that's pretty interesting. So it turns out, this is the guy who started trading one lot, 2 lot corn. And by the time I get to him, and he's kind of not known of it, he's known as BLH. By the time this BLH, which is just one guy in Peoria, it's not a firm, he's trading thousands of bond contracts at a shot. And so I said, yeah, that's a story, right? That's a story. So I go to interview him, but he is, do you know like Gary Cooper from the old Westerns? He always plays these very, one-word, very quiet guys, very, very man of few words. And that was BFL. Just everything was like a 1 or 2 word, it was terrible. I just couldn't get him out. I couldn't draw anything out. There was one point in the interview, he says, well, we're talking about the analogy between poker and trading. And he said, well, could you kind of off the record? And he finally says something that's interesting. And I said, well, why didn't you want me to, what's wrong with that? So he says, well, I don't want it to make sound like trading is gambling. I said, no, you're making good points about, probability and stuff like that. And so he let me use it. But there was so little in that interview that was like good in the interview itself that it's the only chapter in all the Market Wizards books where my narratives is longer than the interview section.
Yes, I understand. And it's interesting you bring that up, actually, because it is actually a very interesting topic that I found is in terms of the analogy between poker and trading, but just generally the relationship or the idea between gambling and trading. What is your opinion? You've interviewed some of the best traders in the world, and of course, some might say, they're just better gamblers, for example. But what would your thought process be on that in terms of, is trading gambling? Is it a form of gambling? Or is it just a very close relationship or line that seems to be there?
Let's take a break for a minute there, guys, because I want to tell you about the best trading tool on the market, TradeZeller. The reason why TradeZeller is the #1 trading tool that every trader needs is because you can do backtesting, automated journaling, trade replay, in-depth analytics, and so much more. And the greatest part about TradeZeller is that it's all automated. All you have to do is connect your MT4 and MT5. It will pull all your data onto the dashboard. You can add playbooks. You can just add notes. You can add images from your trades, and you can get the insights that is necessary for you to progress as a trader. Now, TradeZeller is for absolutely everyone. Whether you're a crypto trader, whether you're a Forex trader, whether you trade prop firms, it is for absolutely everyone. And that is why thousands of traders have signed up using my link here through the podcast. Make sure you use the code RIZ10 for 10% off your monthly subscription, or WOR for 20% off your yearly subscription. The link is in the description below. And let's get back to the episode.
Well, if it's done wrong, it's a form of gambling. So it can be certainly a form of gambling. But traders who are successful, it's not gambling. It's the exact opposite. Because gambling, by definition, almost, you're always don't have the edge. Somebody's making the market, and in order for them to make the market, they have to have the edge. It's a casino or whatever it is. It's the person making the market has to have the edge, or else they wouldn't be in business. So you're starting out with a less than 50-50 probability, and over the long run, you're going to lose money on that. Now, I guess if some people are exceptionally skilled, they could still kind of make money. Like if somebody sports betting or something like that, the odds are against them. But if they're really skilled and are better than most people in picking where the odds are off, they could maybe still make money, but it's beating the odds. And I guess in trading, the odds are against you too in that sense, because it's 50-50 in terms of market can go up, market can go down, but the slippage to put on the trade. If you're not the market maker, you've got slippage. So even there, but the thing is, there has to be that edge, I'm just like, when I exercise, I listen to music, and today just happened to listen. One of the songs I was listening to is a Bob Dylan song, and and so you can't win. And the phrase was, you can't win with a losing hand. So you have to, it may seem obvious, but it's not. A lot of people don't. You have to understand that you can't win in the markets, and you with a losing hand, which means you can't win if you don't have some sort of edge. There has to be some reason why you can beat that built-in edge against you. There's something about your approach that gives you that edge, and you have to be able to know what it is and define it.
And another key theme I recognized from a lot of the interviews you made was that they would be very confident in their ability. They would back themselves. They would almost, and most of all, I found, which was so interesting, is that they loved it. They loved everything about trading, and a lot of them described it as like it's a game. They would treat it as a game, right? And I found that interesting because there's a lot of traders out there who they're not passionate about the markets. They're passionate about making money, which isn't necessarily a bad thing. But I've always made the thought or put a statement of saying, if you're passionate about the money, the issue is that when you lose money, which you inevitably will in trading, especially at the beginning, what happens then? Because it's the complete opposite of your passion. You're not making it. Versus those who are actually passionate about the market as a byproduct of that passion eventually will make the money, as long as they have the edge, of course. What is your thoughts in terms of, you've interviewed a lot of these traders, and is that a common theme as well?
Yeah, and in fact, I think it's been a while since I looked at Market Wizards myself, but I think the very last sentence or something, one of the last sentences, you have to love what you're doing. You have to love trading. That's one of the elements that unites them. And you see it in the language. I remember Bruce Kovner talking about, trading is like a three-dimensional chess game.
Yes.
And Jim Rogers says trading is like there's a puzzle of 10,000 pieces, and they're constantly taking away some pieces and throwing in new pieces. So what are those? Those are game-like analogies. And that kind of tells you, for traders, this is a game. This is something, there's an enjoyment in that. Mm-hmm. And they want to, it's also a matter of figuring out things that other people don't figure out. Mm-hmm. So there's a challenge there as well, which is part of the game. So like a puzzle, right? So it's very important. I think that love of trading is really, really critical. And it's true really for not just trading, but anything. I think if you look at successful people, they're the ones who love what they're doing. So, and it could be anything, and they continue to do it. They might be billionaires, but they're still doing it because they just love the game, right? Yeah. Which doesn't have to be trading, but in our case, we're talking about the trading, and it has to be true for trading as well as anything else. If you don't love what you're doing, don't expect to be great at it.
Did you ever come across any trader in all that time who didn't really share a strong love for trading, but still was somehow successful?
Yeah, no, I can't think of a counterexample. I can't think of a counterexample.
I think that says it all for that.
I can think of an example of a trader that was motivated. In fact, the trader we talked about earlier, in Unknown Market Wizards, who turned 5,000 into a couple hundred million. He got into it kind of absurdly in my mind because he was out of college, didn't know what he wanted to do, and he wanted to do something where he had to make a lot of money. And I would normally tell people, hey, if you just want to get into the markets because you want to make a lot of money, you're probably going to fail. But I guess because he had some sort of innate talent. He had an innate talent of kind of picking up on trends very early before people did. He had that innate skill, and I think that's why he succeeded. But it wasn't a love of trading that got him into it. He did get in for the wrong reason, but he is the exception in that respect. And it only worked for him because he had this critical innate skill, which came out when he started trading.
Interesting. And would you say that is one question I ask a lot of traders is this actually, which is, do you think anyone can be a trader?
No. I think most people can end up being maybe net profitable, but I certainly don't believe that most people can be great traders any more than I think most people could be a great sports athlete in anything, or a great musician, or a great writer, or great anything. People have their individual talents, and a lot of the people I interviewed, I think, just had real innate skill for the markets. Now, that innate skill could be just almost an intuitive skill. Like somebody like a Marcus had that, in my mind, great intuition. He could look at, there could be 100 things affecting the market, but he would be able to pick out the one. I remember, like I mentioned, we used to have lunch together when he was still in New York, and I was a cotton analyst, and I did all this economic research. I researched every cotton market in the post-World War II period. And I came to the conclusion, well, there's only about 4 or 5 markets that were free markets, because in all those other years was a government loan program that was actually ending up providing a floor, and the price didn't mean anything. But that really, I knew it didn't, so that didn't give you much data to work with. And I kind of drew my conclusions from that, although I knew my sample was too small to be meaningful, but it's the best you can do. So we had a market where the price is like 25 or whatever, and it's kind of similar to one of the seasons where the price went to 35. So I'm bullish. Michael's bullish too. But when it goes, my opinion was to go to 35, that's going to be near a top, because that was the one analogous year we have. Michael says, no, it's going much higher because that was the first year that China became a buyer of cotton. Yeah. And he understood if all the, I did all the analysis, he didn't do any of that. But he just knew that the fact that China was a buyer in cotton, that was the key. And he stayed bullish for months and months and months. I started going short in the mid-30s, and lucky I had so little money that I was stopped out and couldn't stay short. So, and it went up to 99 cents that year. So, but he had that intuitive skill. Or he talks about in the interview, he's up late at night watching CNN or whatever, and Russia invades Afghanistan. And he immediately knows, he picks up the phone, calls the Hong Kong floor, and buys thousands of gold contracts and screws the people all the brokers who sold it to him. He said he still can't go there because because they're mad at him. Because he was the one who got him on the wrong side. So, but he had that just immediate intuition, and so you have people with that type of skill.
How important do you feel? Because it's a good example what you made there is in terms of timing. How important is timing the markets at times?
Timing, I guess, for most approaches, it's one of the key elements, and it has to do with the particular approach, the skill. So there are some approaches which are less where timing's less important. I guess part of it depends on the approach. So not necessarily. So I'll give you an example. So it's important certainly for a lot of technically oriented people, but especially on the fundamental side, not so much necessarily. So I think of somebody like Martin Taylor. Martin Taylor, for your audience sake, he was like primarily emerging market trader. When I interviewed him, he was managing about $7 billion and was in the process of giving all that money back, except for about $1 billion, which was his own money and some close friends and investors. And the reason he did that was because he was tired of people looking at monthly returns. People have to sort of, all these allocators, particularly the institutional allocators, they're very attuned to not getting too much of a drawdown in a month or whatever. Yeah. And so, but his thinking, he was a pure fundamentalist. And by that point, he was trading both developed and emerging markets. And in the interview, this came up. His biggest trade at that point was Apple, And it was also, once in a while, his track record was very, very good. But once in a while, he'd have drawdowns into the teens. And this was one of those times. He was like down 17% or something. And almost the entire loss was due to his position in Apple. But he was like, and so his timing was off, obviously, right? But he was completely adamant that no way. I mean, he was actually, I think, adding to the position, which again, you shouldn't do from a risk management standpoint. I would say there are some exceptions that I could think of when I interviewed. He's one of them. And but he was so confident, so sure in his analysis. He explained to me that, he knows what the forward projections are and what people at Wall Street is basing their analysis on. And he said they're just not taking into account the vast global expansion that's going to happen in Apple, particularly in China. And so he knew that was coming. He knew it wasn't factored into the market. And yes, he was saying, I'm right, the market is wrong. And so his timing was off. But 6 months after that interview, Apple had doubled by the time, doubled in that time. And so it's interesting. At the same time, his big short was RIM, which 6 months later had gone from 50 to 2, or something like that. So
it's so interesting when you talk about in terms of like risk and drawdowns, for example, because something that's very common, and I think there's a very large misconception, and I don't, as usual with trading, there's like a lot of the time not a right and wrong, but there's a big misconception in the retail space, I would say, which is like static risk, like just risking 1% and only 1%, and anything above that is considered gambling and over-risking and dangerous. But from my experience, when not only reading your interviews and the interviews you've had, but also just either watching interviews or even some of the traders I've even met, especially the ones who have gotten the returns that a lot of people try for, the millions, the tens of millions, to the 9 figures and beyond. They talk a lot about dynamic risk, meaning that when they have edge and they can see it and they have that gut feeling of that edge is in this trade, they then look to size in, and they'll size in a lot more heavier into those particular trades rather than just sticking static 1% consistently. What are your thoughts on that? Have you seen a pattern in that as well?
So certainly for some traders and for most traders, the idea of not risking more than a small percent, like 1% on a trade, or even a fraction of 1%, is actually a good idea. But, again, there are some important exceptions here. A number of traders have pointed out that when you have real strong confidence on a trade, you have to step on the accelerator. Like I think of particularly like Stanley Druckenmiller, and talking about when he went to work at Soros Management, and he gives a story where he got very bullish on the D-mark. And this was, I think, when the wall came down and, whatever. Anyway, he goes into Soros's office and he gives him this whole pitch, and he says, and Soros asks him, how big's your position? He says, $1 billion. He says, you call that a position? So the point being, if you're that sure of this, why do you only have $1 billion on? And he says, he credits Soros with a number of things, but he credits Soros with teaching him that it's important to be a pig, when when the opportunity is there. He relates a story of Soros when the Plaza Accord back, I think it was 1983, where the dollar had been strong for a long time and all the currencies were way down, and there was this accord to kind of strength, weaken the dollar, strength. And I think the Japanese yen is up 700 points overnight. And Soros hears these people in his office, the traders in his office outside, are taking profits on the yen. He said, stop. Anybody who's, long the yen, you don't want it, I'll take your position. And he said, the Fed just told me that the yen's going up for a year. Why do I want to sell it on the first day? Yeah. So, that idea of really taking huge positions, for some traders, that's a key to how they get these outside returns. And Druckenmiller, who in his 30-year career before he retired to manage his own money, probably averaged close to 30% a year, pretty, on billions of dollars. Pretty impressive. But that average is, we didn't have, I think his losses, he had very few losing years, and they were small if they had them. But he did have some very outsized winning years. So it's not like he was making 30% a year, 30% a year. He had some years maybe with 80 and 90%, right? So that's where, and because when he had the opportunity, there was really a big opportunity, he would, as he said, step on the accelerator.
Yeah. Because I do find it interesting, because I do agree, like majority of traders definitely should, for the majority of the time, be using that smaller risk, whether it's 1% or even lower or around that sort of average. But I do believe in terms of getting to the sort of capital, the returns that they are looking for, like the ones they strive for, is finding that edge, knowing where that edge is present, building that intuition. In terms of intuition, though, because I think that intuition is something that is quite unique, and it's kind of hard to sort of point at and say, this is how you develop that. This is how you can sort of start to trust your intuition more. Is there anything that you've found, or any of the interviews you've made where they've sort of pointed fingers to some things that have helped them to build that? Well,
intuition is an interesting thing. It's real. I mean, intuition is a real thing, and people may dismiss it. Well, intuition is kind of, that's not scientific. It's not. Mm-hmm. But people don't understand what is intuition. Intuition, in my mind, this is the way I would translate it. Intuition is subconscious experience. Mm-hmm. So it's not just something pulled out of the air. You have a hunch. Well, you may have a hunch, but there's a reason for the hunch. I mean, for a good trader, because it reminds them of something that's similar in the past. Maybe you can't identify it, but it's there, and maybe it's not in the forefront of your conscious, but you know it. And so if for some reason you think the market's going up, you have this hunch it's going to go. It's not just out of wild, blind, pulling things out of the air and stuff. It's because it's triggering something in your experience that you may not subconsciously recognize the connection, but it's there. And that's my mind. Mm-hmm. That's what intuition is. It's that type of thing.
And did you find it was like a common theme? And they may not have specifically said intuition, but more so may have reflected it as like gut feeling, or I just knew. A lot of the time that was sort of the terminology used. It was like I just knew that this particular position or trade was going to pull through.
Well, there's an interesting element of this, that part of that also is related to the fact that we as humans just tend to have the wrong emotional response. Wrong meaning that what we want to do emotionally tends to be wrong in the markets. Mm-hmm. It's just because that's the way we're wired. That as Bill Eckhart explained, that people actually do worse than random because of human emotions, because they're seeking comfort, and the market isn't paying off for seeking comfort. So you tend to want to do things that are wrong, and some people can recognize that in themselves even. And like a trader I interviewed in the last book, John Netto, mentions that let's say he finds himself that he's long gold, and the gold runs up, and then he thinks, oh, it's going to the moon, I got to triple up, And in his case, he said when he sees them, when he goes from just kind of a solid based opinion on the markets to kind of being, I got to get it before the market runs away. That to him is a signal that it's going to react, that he's wrong. That for the short term, at least, it's going to go the other way. So almost in that case, the intuition is tapping into your emotional response to to know that that's wrong and that you could do the opposite. So that's another form of intuition, and is that's come up a number of times in interviews, that type of thing. I've actually, I just had a situation like that myself, where I was looking for the dollar to, and I only trade in a hobby and just occasionally, but I was looking for the dollar to weaken. I thought that I'm going on the premise that there's a top end. So I had a position in a number of currencies, all basically bearish. The dollar, and I analyzed the Swiss franc chart-wise, and I picked my point. My point was like 100 points, 150 points below the market. And I kind of recognized, though, if I get that executed, that my other positions I have on are going to lose money. So I didn't want it to be right, and my instinct when I was going through the charts was I got to cancel this order. But I knew from past experience that when I cancel an order because I don't want the market to go somewhere, it usually ends up being, that order ends up being right. And so sure enough, I was wrong on at least on the timing of the dollar, or at least for that short term last week. And all, the dollar corrects and the currencies go again. So I took a loss. So I got stopped out of my really close stops on a lot of positions. And sure enough, the market went just down just enough, a few points beyond where I had my buy. So I got long the Swiss franc. And today I raised it to break even. So that's kind of an example where it was, I don't putting myself out of good trade, just the opposite. So my intuition, my emotional response is so bad usually that if I can recognize it, then I know I can bet against it. So my emotional response was, hey, I don't want the market to go here, take it. Take the trade off. No, but I knew then I should leave the trade on. So that's a personal example.
Yeah, no. Thank you for sharing that. And I find it so interesting because I know a lot of traders, there's like a big debate at the moment that is happening. I wouldn't say too big, but they're saying like trading psychology is what they call bullshit. They're saying the trading psychology is not important. But how they're reflecting that is saying that it's all in the skill set. If you focus on the edge, and when you're confident enough in the edge and understand that edge inside and out, the psychology sorts itself out because of the confidence that comes with understanding that edge and how it performs over the long term, etc. Therefore, those wins and losses and the emotions, the heightened emotions that come with that, start to dissipate, start to sort of flatline a bit more. And I find it interesting because I get the concept of what they're going for. But equally, when we talk about intuition and gut feeling and just human psychology and emotions, is it as simple as that? Is it as simple as that people are focusing too much on the fear, the greed, the FOMO, the over-risking, etc., and trying to find the hacks, the mental hacks to solve that? Or is it that really they should be focusing on the edge and having that edge in the first place?
Well, that mindset that you mentioned where people say they have, a method that works and they have an edge that's a way, and if you assuming that part of that is married with risk management, well, that you've just described the way of managing emotions, so if you have a specific approach and it gives you specific entries and you always have a risk control to those entries and you have the discipline to do the entry and the exit exactly as dictated by your approach, which has a proven edge over time, well, what you've done is you've addressed the potential psychological weakness that people have in trading. You've kind of defined it away because you're not letting emotions enter into the equation. You've got a specific entry, you've got a specific exit, and you've got the discipline to do both. So in that case, psychology no longer becomes important because you've set up the methodology to eliminate emotions from trading, which is actually a good thing.
So it is interesting because I feel like a lot of people don't focus on the most important aspect, well, not the most important aspect, but one of the most important aspects of actually having an edge first, doing the work to formulate that edge. So to know the edge, the numbers of what that should look like. And because of that, they end up having a lot of psychological issues and the emotional issues. And therefore, what they tend to do is rather than focusing on any form of the edge, they're now spending their energy on psychological issues of, okay, I'm over-risking. Why am I doing that? and then their attention's all over here versus actually having clarity in the markets of what they're looking for and why they're looking for that and how that performs already based on either past data or the data they've collected over time. Have you found from your experience that the traders that you've interviewed, they've done extensive time to formulate an edge, done the time to collect the data necessary, have really put in time before they started to make any consistent profits or huge profits? It was that they actually dedicated time and study, and it might have not been and I would like to assume it wasn't a short period of time either.
Yeah, I think that's generally true. And the amount of work can be immense. So I think of some of the traders in the last book, particularly, I know a few of them came out with binders of they would keep on all their past trades, right? So write-ups of analysis of every past trade and what they were thinking, how it worked out, just reams of, and then they review it like monthly just so to reinforce those lessons. So there's a lot of work that typically goes in for most traders before they're successful. That's absolutely true. Yeah, that's people's misconception is that trading is an easy way to make a lot of money. That's what people think, but that's not reality.
One thing I've heard you, a quote that I believe you've said, but also has been reflected from one of your interviewees or one of the traders that you knew personally, was knowing where to get out before knowing where your profit is or before getting in. Why is that so important?
Yeah, so that's out of all the books I've written and all the advice I can give people, and I've said this before, I said, if somebody said, Jack, you got to give advice to trading, but there's only one catch here. You could only use 10 words. And I know what the 10 words would be. And it's a line that Bruce Kovner had. He was the first interview where I had that particular thought. It came up a number of times, but he was the first one. And he said, I know where you will get out before you get in. And now that's so critical for a couple of reasons. First of all, if that's true, then you've defined your risk on every trade. You can no longer have this turmoil. Should I stay with the market if it's going up? Should I get out? If I get out here, I'm going to be getting out. You've already made that decision. You don't have to kind of beat yourself up and have that mental anguish about it. You decided that before you get in. Now, here's the thing. Why is deciding that before you get in so important? Because the only time you have true objectivity is when you do not have a position. The minute you put that position on, you've lost your objectivity. Any news article comes out, you say, well, yeah, this may be bad for the position, but it's already discounted. The market already knew this, and you keep on making excuses. Everything is trying to translate it in a way that is okay for you, because that's human nature. You don't want to have made a mistake. You don't want to be wrong. So you lose your objectivity. However, if you decide before you get in, then you said, I think the market's going to go up or down or whatever it is, but if I'm right, it shouldn't go here. And you've made that in a completely rational sense because you had no horse in the race. You were fine. You were thinking purely clearly. There was no human emotion that was distorting your opinion. So that's why. That's why I say of all. There's tons of advice that are in the books, and in some books, they end the chapter. I might have like 40 points from the main point, but the single most important point that I think in all the books is that one thought.
I love that, and I think the last portion of that was so important in terms of the calm mind or the calm thoughts of, okay, before you're in the trade, you're thinking clearly, you're thinking objectively of, okay, this is the data, this is the point where the risk makes sense. But then when you're in the trade, that's when the turmoil can begin, and those thoughts of ignoring certain points and sort of having a bias and perception based on what you want to happen, you start to ignore anything opposite.
That's the trick there. Mm-hmm. What you want to happen. Be careful. And I forget which interview it was, but somebody says, mm-hmm. You don't want to be trading what you want to happen. You want to be trading on what you know will happen. You got to be very cautious. And the example I gave you before, when I want to happen, I didn't want the market to be able to get to my buy point in the Swiss franc. I definitely didn't, because I knew I would be losing in the other positions. So you got to be careful about what you want. What you want is not only irrelevant but often negative to your position.
Definitely. Another sort of misconception I've seen, and it might be right for. Like, a misconception is that you can never make huge sums starting from a small sum, right? So such as 5,000 to tens of millions, for example. And that might be a right thought to have on the general basis, like for the general community. It may not be a possibility, but from a theme from a lot of traders I've seen in the book, they started very small in terms of their size. And they've ended up in a position where they're trading tens of millions, hundreds of millions, even into the billions. What do you think to that? Is that something that is the journey of that, not necessarily that they started themselves with a small capital and themselves only got it to large capital, and that due to their skill set over time and then being able to manage larger funds, take investor capital on board, that's what allowed them to scale? Or is it a possibility that traders can take small sums with the right skill set and edge and actually be able to develop to large capital?
Well, certainly, from my experience and traders I've interviewed, so I've had quite a number of traders who started with small amounts and built into large amounts. But what may also be maybe more common is not necessarily that. You also have the routes where a trader doesn't compound, as I mentioned. Quite a number of traders, because their technique, this goes all the way back to, not only the traders I interviewed more recently, but back in the original market wizard, Barney Schwartz. Barney Schwartz had this ridiculous track record for like 10 years when he was just insane. In fact, he was entering these trading contests, and they were usually 4-month contests, and sometimes they were 1 year but he was literally making hundreds of % every 4 months. It was crazy. And this was documented. And anyway, so he had this astounding percentage returns, hundreds and hundreds of % a year, and he only had like 2 losing months in that whole period. And they were minor, very small losing months. In fact, he joked those 2 months were the months his kids were born. He was distracted. So this was crazy, and people. And I know when I give a talk, sometimes I mention him as his example. I talk about Schwartz, and I say, I know the quant guys in this audience are probably thinking, hey, wait a minute, whatever it was, like 600%, 700%. Said compounded, it was. I remember the statistic. It was 25% a month.
Wow.
Over like 10 years. And I said, I know a lot of you guys are kind of thinking, gee, that 25. Why doesn't he have like, 1/5 of the GNP, because he wasn't compounding. He kept on pulling money out and putting it into T-bills. He couldn't trade. He couldn't make he was a short-term S&P trader. He couldn't compound his trades like that because he would start affecting the market. So in many cases, the traders don't compound it. They have very good, tremendous return risk, but they keep the trading size not small necessarily, but it doesn't compound, right? And the other thing is where traders go into much larger size, they no longer have the same % returns. Somebody like a Bruce Sumner, when I interviewed him, I still remember he had like a decade of 88% average return. When he went and started Caxton years later and was managing tens of billions, he's not going to do 88% a year. I don't know what the track record was. I think they did fine, but God, it was nothing like his track record as an individual trader. So there are a lot of different routes on that.
What is the reason behind the fact that once the capital starts to get larger, the returns start to also reduce slightly, or
because you start to get in your own way. If you get too large, you can't just enter into the market with huge size in and out without actually impacting, creating a lot of slippage on your own. So I think you become a factor. These traders who do very well when they're not significant, they can do whatever they want. It's not going to affect the market. But if you're becoming large enough to really impact the market, then your own trading is getting in its way. So I think it's harder to manage large sums of money. Some people think, oh, these hedge funds have an advantage. They manage the large. No, I think that's a disadvantage. I think managing large sums of money could be a problem.
Because a lot of people try and say that it's unrealistic to have even, say, 20% a month average return, or 40% or 50%. It's not possible, some try to say. But then again, reflecting back to a lot of traders in the book, they have these returns. They have these insanely powerful returns, insanely incredible returns. And it's not just a single trader. There's many traders who are doing it, and they're doing it on higher capital in comparison to the general audience that we have with us. But it seems to be the ones in the general audience who then try and give, not all, but some, try to give this, I would say, a limiting belief of 2% on average return is what you should be going for as a trader. Not 2% on average monthly return, sorry, is what you should be going for as a trader, 2 to 3%. Anyone who's trying to say that you can get 10% or 20% a month is unrealistic and wrong. But then when we reflect on people with proven track records and are trading actually more, so substantially more capital, they're able to achieve these returns.
But they are the exceptions. They are the exceptions. And for most people, that would be highly unrealistic. So there's a difference between it can be done than it can be done by most people. That's not the same thing. So yes, it can be done. Yes, it has been done. Yes, it's being done. And yes, you may be the person that can do it, but realize that you're probably not. And it's not real. And the whole idea of targets, by the way, is not a particularly beneficial concept in my mind. And this has come up in a number of interviews. Most recently, trader Amrit Sal in the last book, who I asked him, he worked in a prop shop where he saw lots of other traders, and was asking him, well, and he's one of the traders who had I think a 300% return for well over a decade. And what was it that he saw in difference between traders who succeeded and failed? And he said one of the things about traders who failed that he noticed was they tended to have a target of making some percent every month. And his point was that if you have a target of trying to make X percent every month, you're going to be taking trades you shouldn't be trading, and that's actually going to impact your trading results negatively. Because the market, whatever your approach is, the market is not a machine that constantly favors every particular approach every month with the same potential. In fact, most approaches go through periods where there's very good opportunity and sometimes where it's very adverse to the approach. But if your mindset is, I'm going to try to make the same percent every month, then you're going to find yourself trying to, when the opportunities aren't there, taking trades that you shouldn't take and end up losing money. So the idea of targets is not a particularly beneficial one.
That is interesting, because even when it comes to capital, for the average retail trader, returns is definitely one thing that they a lot of the time put targets on. But equally, a lot of them also put targets on capital amounts due to the certain things that they have access to, whether it's the new age of what people call prop firms or these funding companies. And they put, and I believe it's a negative as well to do that, where you're saying, okay, by, 6 months' time or a year's time, I want to be managing X amount of capital. Because it's just the pressure and you're putting this weight onto your trading. And as you say, you then start to make decisions based on this thing that doesn't exist yet. And yes, it's good to have goals, but I do believe in trading, it can be very detrimental to the trader. Would you say that when people do that, so it's not very similar to the targets as you just mentioned, but when it comes to any form of sort of pressure or weight that can be added onto the trading, it's just a negative to a trader?
It's negative in the sense that the realization is the market isn't there to provide, to favor your particular approach. The market will do what it will do, and you can't force the market to fit what you want it to do. So you need to be flexible to attune to what the situation is. And if there are very few opportunities, don't trade.
What's been interesting with the Market Wizard series is that the first one was back in 79, was it?
The first one was 88. I wrote it 88. It came out 89.
89, sorry.
Yeah.
And then subsequently you did one very recently, I believe in 2019.
Yeah, 2019, and it was updated 2023.
Amazing. So in that time, though, there's been huge changes in trading,
Yeah.
in the amount of access to trading as well, and trading styles, and maybe even new markets have occurred. Is there anything that you saw different in traders going from the original book to the latest book?
You know, it's not really in essence. I mean, the changes that occurred, the big changes that occurred, and we talked about earlier, let's say you've gone from pit trading to electronic trading, doesn't really change the methodologies that are being used. It doesn't change how the traders are trading. The fact that we have all this computerization means that a lot of the approaches that are being used couldn't be used before because computers weren't there to provide the data, to provide the technical analysis, whatever it might be. So in that sense, it's modified. And the fact, so let's take an example of chart analysis. Things that might have worked well 20, 30 years ago maybe don't work so well anymore. Like Peter Brandt, who is a chart analyst, bottom line. But he's clear that there's very little edge in chart analysis. All it does is it tells him which points have a potential of having a good return to risk ratio, but the predictive power is low, and a lot of the technical patterns that may have worked 20, 30 years ago, he'll say now no longer work. So he kind of focuses on those that still work. So there's adaptability. Things do change as the markets change, but not radically.
In terms of like new markets such as cryptocurrency, for example, was there anyone in the series that sort of fit into that bracket? Were trading those sort of markets?
So I personally I didn't seek out any crypto traders per se. Some of the traders that I interviewed also will trade crypto because anything that has prices, a price chart, that's trade or is affected by human emotion, they'll trade. So so some of the traders did trade crypto, but it's just another market. I didn't interview any crypto traders per se.
What are your thoughts in terms of like the changes you see in the industry? So yes, we've had commodities, you have futures, we have Forex, we have the currencies as a whole. We have so many markets, and then something digital comes along, which there's a lot of debates about, of course, the digital side and how much weight is there. But what are your thoughts when you see this progression and new markets forming, and a lot of it is still quite new, so a lot of it is still quite unknown, and that people do find edge there still? But what are your thoughts in terms of when you're seeing these changes within the markets?
Well, as far from a trading perspective, it's just another market. Anything that is liquid and has buyers and sellers, and you can buy and sell it, and has price patterns or whatever, it becomes just another market, whether it's meaningful or not. So a lot of cryptocurrencies, in my mind, probably the majority, will ultimately be worthless. Okay. So that doesn't mean in the interim that they can't. It's true of a lot of stocks too. A lot of stocks, right? In any Fed that comes along, there's always a lot of stocks that are around that don't have any reason to exist and will burn through money and eventually go not. But while they're there, they're tradable. It's just another market. So I think crypto is in that category.
Do you think it's very similar to the .com bubble?
I do. Yeah. I do. To me, it seems that way. In the sense that, sure, you're going to have Amazons and you might, so which you translate Bitcoin or whatever it might be. So you'll have a couple maybe that survive, maybe and do maybe very well. Although I'm skeptical about that too. But I have rationalizations why it might be true. But for the most part, most of these, when there's hundreds or thousands of these, where people are just making them up as jokes, and they trade huge money until they collapse.
Yeah.
So that has all the signs. And NFTs, just crazy, where there's no rational reason why these things should have value. So those cases, I think, that eventually they just go by the wayside. So in that sense, I think it will this era of NFTs and crypto will be looked upon, even if a few of the cryptos still stay extremely profitable longer term. I think for the most part, the bulk of it will be seen as a classic mania. It has all the earmarks of a classic mania.
Yeah, because the reason I made that sort of comparison is because if I remember correctly, back then there was a huge bubble. Anything with .com included on it was essentially just getting investments and was listed on the stock market and would grow and sell and be in sort of buzzwords. But then eventually it was the ones that only really fit into society and had infrastructure, actually had value.
Right.
That lasted after that time.
Right. The majority went by the wayside, but there were a few that were super successful.
Yeah. In terms of GME, for example, obviously we see the rally. This was the funny thing. I watched a film, I think it was just last night we watched it, in regards, it just got made onto Netflix. And it was all about that whole situation. I didn't even realize they made a film. It was quite fast to make a film on it.
The one on GameStop.
Yes, on GameStop. It's called Dumb Money.
Yeah, I saw it.
Yeah.
It was pretty good.
Yeah, and I found it so interesting because people debate, and the reason I'm bringing it up is because people debate quite often about the market, how it works. Is it buying and selling pressure? Is it just a reflection of emotions? Is it, nowadays it's like, is there an algorithm that delivers the price? But then when I see something like that happen, it kind of becomes more obvious but it's the relationship between the buyers and sellers. And for the most part, yes, the institutions, the big players are the ones who get to have more control of that price, just simply because of the size that they have within the markets. But then when we see a situation like this take place, it kind of, I don't know, in my opinion, it proves that the buyers and sellers are move the charts, move the price.
Well, it's a classic demonstration of why the efficient market hypothesis is wrong. Because there are periods in the markets where prices deviate greatly from where any common sense. So there's a saying the market's always right. Well, in the sense that you can't fight price and all that, you'll lose money. But the market is not always right. I mean, traders make money by figuring out when the market is wrong. And GameStop, the idea that GameStop goes from 20 to 500 with no real change in anything, that was correct. And then when it went right back down, that was correct. No. And the same thing with the internet stocks, same thing. They go up 600%, and in 18 months they go down all the way back to where they started, the index, 17 months later. No tremendous amount of news is coming in that's bullish on when they're going up. And it is that people are in this mania, oh, my neighbor's making so much money in internet stocks, or my neighbor's making money on GameStop, whatever it is, that they have to get in on the bandwagon, and somebody is finally the last one when the music stops and is left holding the bag, and it goes all the way back down again. So that whole move up and down is just nonsense. And that's essentially what was a GameStop. It was just that. It was one guy influencing a bunch of other traders take the position, shorts getting squeezed and having to then cover, and then the suckers are left. The suckers who come in $300, $400, $500 because they think it's going to 1,000 now, are left holding the bag. So that's the way markets work. It's human emotion going through these manias, which happens time and time and time again.
Have we ever seen one where it happened on the same stock again? Because he's...
Yeah, well, you're seeing it now in GameStop.
Yeah.
You're seeing it in GameStop again. Yeah.
It's so interesting.
And you have another, you have all, it's true of any meme stock. So something like DJT, right? DJT is kind of makes like $4 or $5 million and loses 400 to make it, right? It's not a business that's survivable in any sense, and yet it's trading at billions and billions of dollars. And there's no metric that can explain that. There's no metric that can explain that. So you get people doing it because they want to express their political belief or something like that. But and you see the insanity. I do have an article if people are interested. I wrote several weeks ago. I put it on LinkedIn. Why something titles like something why anybody who's long DJT is a fool, and it's because the option market is kind of reflecting the insanity of it. Most cases at the market strikes and puts and calls are roughly in the same ballpark, right? Mm-hmm. But in DJT, the puts are immensely more expensive than the calls, and you'd think, well, why isn't that arbitraged away? It isn't arbitraged away because people can't borrow the stock and accept a tremendous cost to go short. Mm-hmm. So that's how you get that. But the option market is telling you there's an insanity here. I mean, it's so far off from any normal option behavior. It's striking. So my basic point there was, hey, if you really want to be long DJ, and he was long DJ, he says a fool. You should basically create a synthetic arbitrage position. You know, you should basically sell the put and buy the call. You know, and you'll have a proxy long position, but you could actually make money because the distortion is so great that if the market doesn't come down sharply quickly enough, you might still end up making money because the puts are so expensive. So that's an example where the market inherently is telling you it's nonsense. You know,
it's interesting you bring that up because I interviewed one trader, and his style is what he refers to as glitch trading. And it was very interesting because I never thought of this as being an edge. And it'll be interesting to hear your thoughts. His whole edge is finding discrepancies in trading platforms, trading data, and then just trading that. So he goes, for example, let's say if one platform had one price, another had another, or if price was delayed on one feed, etc. He would that was his whole edge, was finding these glitches.
Well, that's great. That's really just an arbitrage. I mean, arbitrages are hard because they usually get traded away quickly, you know. Yeah. So, but if God bless him, if he can find arbitrage opportunities in the markets, that's kind of the best. That's an ideal type of situation because by definition, there's no risk and return. But those trades don't last typically.
Yeah, exactly. That's what he was. It's like they're very quick, and what he was, because I asked the same thing. And it was so interesting because he goes that it was a big thing more so a long time ago, but the markets are more efficient now and have upgraded over time. But he said now the whole edge when it came to that is over in crypto because it's so new, it's unregulated.
That's a good point. Yeah, so I could believe that. There's probably and so and that probably can exist. Exactly right. So that'll eventually get traded away, but. As long as it's there, that's a great approach.
I just found it fascinating because it goes outside sort of the general thoughts we have when it comes to edge. And I was like, wow, that's
a great approach.
If that's something, it's just so different. That's what I love about the markets. That's what I love about the industry is that there is no, you have to do it this way. Just as we talked about technicals, fundamentals. One thing actually, going back to that, I think it was so interesting because there were some people you would interview where they would literally say that no one can make money just using technicals, for example, or vice versa. Like, you know, fundamentals are useless. And as an interviewer, you hear it, and yet you know it's wrong what they're saying in the sense that there are people who make money using technicals, and there are people who make money just using fundamentals. And we obviously we're not trying to bring our opinion, and you're not trying to convince them. But what do you think that is, where people have this really strong conviction that that's not possible? But yet you know it is. But it's like their belief is literally like, even now, I've met people say scalp trading, like very quick in and out trades, it's not possible, they say. But I know scalp traders who are very good. Equally, people who don't use fundamentals, for example, they say those traders, they can't make money. But I know traders who can. And I just always find it fascinating where people are so sure and they truly believe it's not possible to make money doing these things. But as you know, me and you have known, and especially yourself from interviewing all these different types of traders, where do you think that comes from?
Because it's within their own framework of what they see and believe. That's the reality, and that's their people. And the successful traders end up trading their personality, and so part of that personality is somebody like a Jim Rogers. Part of his personality is the belief that it's all a matter of fundamentals and that, you know, technical nonsense is just a bunch of nonsense. And for the most part, for most people, they're right. I mean, Jim Rogers' line was, I never met a rich technician except those that sell their services. That's his framework, right? And in that sense, he can find the justification because it's true. A lot of the people that are selling their services really aren't selling anything that works truly well. And so he's right, but it does not extend to the point that there aren't Marty Schwartzes out there that can make technical analysis work extremely well. So it's like sometimes when I give talks and I contrast to make the point that there's no single approach to the markets, and I actually use Schwartz and Rogers as examples. Schwartz says, I spent 10 years as a fundamental analyst and lost money every year, and I got rich as a technician. And Rogers with his cynical line about the market technicians. They're complete opposites. So who's right, who's wrong? Well, in a sense, they're both wrong about the other one's approach, but they're right for themselves. Fundamental analysis works for Rogers. Technical analysis works for Schwartz, and it goes down to it being critical that every trader find an approach that works for them, and understand that whatever that approach is, there are people with completely opposite opinions of that, and it doesn't mean it can't work.
So I find it fascinating. I enjoy it because I share the same thought as like that anything can work. It really does come down to that edge, but I just always find it fascinating when I hear people say it because it's always such a strong conviction. It's not like a passing comment. It's never just like, that doesn't work. It's very much like that does not work.
And in a sense, they're right because most practitioners of both broad spectrums, fundamental analysis and technical analysis, are not successful. So in that sense, they're right. But it doesn't mean that there aren't a select minority who have an approach that does work in each category.
One thing we've seen over time, because I remember that one trader you interviewed really reflected this as well, is that they had a lot stronger edge at a particular time. And as trading became more accessible, their edge started to diminish in that side of things, and then they had to adapt. How much has the market or market participants, how much has that impacted the markets? Because there was a time where there was a much more select few who could actually trade.
Sure, it's made a big difference. Something like, take trend following as an example, okay? So, first Market Wizards book, I'm interviewing traders who late 60s, whose track record is late 60s, 70s, 80s, right? And so from that time period. Well, you go back to then, somebody like an Ed Secoda. Ed Secoda started trading late 60s, beginning 70s, whatever, late 60s, I think. But anyway, he talks about he would get a job at a brokerage firm so he could use their mainframe over the weekend to program trend following. And he wasn't programming anything super complex. It was really just like trend following program and stuff like that. But he was one of the few people that were doing it. The people weren't doing it yet. And somebody like Marcus was also trading trends, but not doing it with a computer, but who was also kind of considered Secoda a mentor in a way. They were connected. But Marcus would, do it. He would just do it by looking at the charts and get. But that whole approach, that whole trend following approach, that was Dennis's heyday as well and stuff like that. So in that couple of decades, trend following worked really well, but it became more and more popular. And then you started getting, and particularly once you got PCs and software and charts available to everybody and all these books and all the articles, and forget nowadays with all the stuff you have. So once it becomes super popular, it no longer can maintain the same efficacy anymore. And so what happens is there is a rationale, there is a reason why trend following conceptually works. And that is because there are trends in markets. The world is filled with true trends. I mean, that's how the world works. For example, if you get a shortage in a commodity or something like that, well, let's say there's a shortage in copper. Well, it takes years to open a copper mine. The thing can develop for quite a while. And once a whole bunch of mines come on stream or shipping, let's say shipbuilders, you got another great example a number of years ago where there was a shortage of ships and you have shipbuilders like shipping rates go way up and shipbuilders do great. And then there's an oversupply and it goes the other way. But once those trends start, there's a reason why trends stay prolonged. So there is truly rationale behind trend following. But what happens when it becomes too popular? Mm-hmm. Well, it becomes too popular, you start getting a whole bunch of fake breakouts and very short-term wild swings. So it becomes very difficult to stay on the horse. Mm-hmm. So the trends are still there, but they become choppier. And I haven't done the mathematical analysis, but I'm sure, I kind of believe that if somebody, did the analysis on the variability of prices within trends, they would find that over the years, there's a lot more variability, there's a lot more short-term moves counter to the long-term trend, enough to make it unprofitable for a lot of automated trend-following approaches. So that's how changes in the market, in this case technology and popularity, combine to take a methodology that printed money and make it the edge. There's still some alpha there, but return to risk wise, there's a lot. The drawdowns are very big too, so there is an edge there, but it's no longer the return risk that existed with the approach many years ago.
One thing I wanted to ask you in regards to, with your interviews, you're a lot of the time going to their offices or even to their home at times as well. Was there any indication you saw from these traders of how they were living, in the sense of were they very lavish people? Very, you see, for example, on social media, the trading industry, how it's presented on social media is very much lavish, flashy things and a particular lifestyle to promote and to sell a service a lot of the time. But these actual, these professional traders that you've spoken to, what was that? What was the reality of that? Were they very lavish people, or were they more sort of focused on the job and task at hand?
I think it depends on the individual. Certainly in many cases where they had made tons of money, they did spend lavishly. And in other cases, not particularly. I think that becomes it's like anything else. There are people in, let's say technology or something like that, who've made fortunes, and some of them live lavishly and some of them not particularly.
That's fair. And in terms of,
Warren Buffett's a famous example.
Yeah, massively
not
famous
technology,
example.
but Warren Buffett's the same example, right? Tremendously rich, but kind of lives the same way he's lived. All that becomes a personal. That goes to the personal, the individual person.
Definitely, definitely, he's a prime example. To be fair. I don't know how he still does it. He still does it. It's incredible. I guess it that reflects quite well in terms of he must just really love what he does to still be doing it and to still be living that life.
Absolutely, he does. You could see it in anything he ever says. Absolutely. Not doing it. Certainly not doing it for the money.
That's it. And what about? Did you ever get to speak to the traders on sort of the routines that they would sort of have in place around their trading? And if so, how important it was to their trading itself?
Some traders, they typically have their routines, right? Say, Brand won't trade during the day or even much during the week at all, really. But every Friday we'll do his analysis of the markets. Some of the traders I mentioned, the binders, right, kind of have this methodology of writing up every trade and preparing for every trade and getting very focused on any trade they plan, so each person usually has some routine that fits with what they're doing.
Amazing. And I really wanted to ask you as well, the term market wizard is very widely used now to refer to traders, and even people use it for certain branding or their username or their tag name, and it's very much a recognized term within the industry. But before you came up with the book, was that a term? Was it a well-recognized term?
No, I think I can take credit for that, but I don't even know where I got the name.
Really?
I just thought it was sounded like a good name. I don't know where I got the idea, or, I don't know if it was my idea, my wife's idea. I don't even remember.
That's incredible. That's incredible. And as I say, it's so widely recognized now. And in terms of the publishers of the book at the time, did they have any sort of indication about this was going to be as successful?
No, they... I like my publisher now, but I hate my publishers from before. But they really blew it. So Market Wizards came out, and there was a Wall Street Journal article that reviewed the book. In fact, I still remember the columnist was Stanley Angrist, and he gave it a nice write-up. And the book sold out overnight. Publisher just took months to get more copies printed. It was crazy, So the book sold out, and they don't have any copies. It's like no, they certainly didn't have any idea, and they didn't respond quickly enough, to the situation. So they kind of blew it in that sense. I mean, the book has continued to sell year after year after year.
Definitely,
so it's still, I guess in the long run it didn't make a difference. And maybe it was good that it wasn't available. I don't know. That got more people interested originally. I don't know.
Kept that demand high, keeping the prices high. In terms of future books, is there anything? Because I know the last one wasn't that long ago. Yeah. Is there any sort of thought process of future books?
I don't have. I don't think I ever planned another book after I finished one book. But eventually, I got around to the point where I felt like writing one. So I'm basically retired at this point and don't have any plans to do another book. But I know from experience, I shouldn't say I never would do another one. I just don't plan one. I think if I ever did do another one, I think I would probably want to title the last Market Wizards book. So force myself not to do it anymore. But I'm not planning it another one.
Well, you've already had a tremendous impact on the entire industry, as I've said. My last question is a bit more of a selfish question, which I could obviously ask you off camera, but I know there's a part of my audience who also do what I do, which is obviously like content creation and interviews and so on and so forth. So what advice would you give someone like myself who's essentially trying to emulate the sort of impact that you've had in a slightly different way with video format, but at the end of the day, still interviewing and the core concept is there? What advice would you give to me to be able to try and improve or to emulate and have a career like yours?
Yeah, so I think you're already doing, as I mentioned before, so one of the key things I've done for myself is to we're talking about interview type endeavors, right? So is to have a conversation, listen to what the other person's saying, and the worst interviewers are the ones that ask a question, have a list of questions, and just go on to the next question. And I can hear it. When I get interviewed by somebody like that, I can almost visualize them with a paper and go ticking these things off. And it's, I wouldn't say annoying, but it's kind of, it's off-putting. So that it's very unprofessional, it's very poor. So I would say if you're doing interviews, think in terms of conversation, listen to what the other person's saying, because the answers often will lead to better tangents than the questions you had to start off with. I would say in anything, I always believe in trying to do your best, not cutting corners. You're kind of doing it by doing this professional setup, studio setup and all that. So you like I say, you're already doing that. But a lot of people don't. So I think striving for excellence is always a good thing, and do something you love. So, like anything else, if you're doing a podcast because this is something you really want to do and you want to talk to these people, great. But if you're doing it to try to get rich quick, it probably is not going to go anywhere. So those are some of the thoughts.
I really appreciate it. And I really appreciate you spending time with us today. Like I said, it's truly an honor. And I guess on behalf of the trading industry, I know they're not there, but on behalf of the trading industry, I would just like to say thank you for the massive impact that you've had.
Well, thank you very much.
Across everyone, because it's been absolutely incredible. The insights that people get to learn from people they probably would never have heard of or had access to, it really has had that impact. So again, thank you, Jack, for being here. And I don't know if you do have any links, but any links you do give to me, I'll put them in the description below for you. And everyone at home, drop a comment with your biggest takeaway from today's episode. There'll be links in the description, as I said. Hit subscribe, and until next time, everyone, take care.